Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. The 13th of June, not Friday, Thursday, 1 o'clock on the East Coast. Guy Adami, Dan Nathan, soon to be joined by the great Carter Braxton Worth. If it's Thursday, it's
Butters.
Bitch. Yes, it is. Yes, it is. And before we bring in Carter Worth, we have a great team here at Risk Reversal Media. You know this, right? I mean, Jacob, Amanda, Timmy, Bill Hockman. So Hockman texted me before the show, and he says, you know, the fact that you haven't talked about Aaron Judge, this recent performance needs to be addressed. And I thought he was saying, clearly, he must be doing some, you know, enhancing drugs type thing, right? Which is negative. That's not what he meant. He meant that the run that this man has been on for the last month and a half, 2 months is historic in a word. Not that you can do this, but if you were to prorate the last 40 or so games, the man would hit 80-something home runs, have 180-something RBI. It's ridiculous. So Aaron Judge is now solidified himself, Dan Nathan, as probably the preeminent player in all of Major League Baseball. How are you, by the way?
I'm doing great. I mean, we could have used a little of that last year, a year that the Yankees did not make the playoffs. I'm just saying, you know what I mean? Like, I'm happy to have him, you know, doing what he's doing right now. Let's hope we don't have a summer slump. Let's get to it, Guy Adami. Chart check with Carter Braxton Worth. He's going to be with us in 1 minute. Every time I say chart check, I almost say with charter. Which would actually work given his acumen on the technical analysis. He's going to give us a sense of where he thinks the S&P could go and relative to the equal weight S&P. We're also going to talk about his bearish call on yields, which is proving correct, and where he thinks yields are going. Guy, we got to talk a little bit about the Techapalooza that's going on here. It is really kind of getting pretty narrow in many ways, and we'll kind of hit the semis versus software again. Adobe after the close reports. You're going to be all over that on CNBC's Fast Money. You know why I know you're going to be on CNBC's Fast Money? Because you're all knotted up today for the market call. And lastly, like you kind of alluded to, if it's Thursday, it's...
You got to say it.
Butters.
Bitch, yes, it is. I know. And I'm sure there are people from FactSet watching that, and I'm, you know, but you know what? We've created. Think about what we've done. We've created this.
He did it. It was a fat pitch for you, Guy. Okay, you know, Butters is the living legend here. We love his work.
Yes, he is.
We're gonna get to that in just a little bit. All right, let's bring him in. Carter Braxton Worth of Worth Charting.
Whoa,
there he is,
man.
Casual Carter. Casual Carter. Yeah. Listen, Carter, let's just get right to it here, man. What we've seen in the S&P and the NASDAQ, pretty interesting. The Russell really trying to get on its horse, Guy. This would be the small caps, and it's really closed on the lows yesterday after being up nearly 3% or so, down 1.25%. But Carter, let's just get to the S&P 500 here, man. You've been charting this for a while. Where can this thing go to the upside? We know that you're a measured move sort of guy. We had that breakout. It was a false breakout. We retested that uptrend. We see the lines that you've drawn. You know, we had that gap yesterday after CPI. We're kind of holding in here. Break it down for us, my man.
I mean, you know, it's a minor breakout, right? From a minor formation, not a lot of duration to it. But I think what's important is that it's only this index, right? So the S&P mid cap 400, small cap, the New York Stock Exchange Composite, the Value Line Index, the Dow Jones Transport, it just one after another is not sort of going along for the ride. Obviously, we know why. It's Apple pushing higher just in 2 days, an epic sort of move, NVIDIA. But if you juxtapose this versus the equal weight, an exercise that's been done over and over, let's go back and forth. There it is. And if we toggle, we're just, you know, those are different pictures. Those are different stories. Those are different narratives. And so what is so curious here is of course the struggle that's going on in big banks, some of the big industrials, some certain retailers, so that with rates now at 4.25%, which should be some kind of elixir, right? According to the people who believe that that's as simple as that, low rates, high market. This is something's wrong here. And we, you know, or not wrong. That's the market's never wrong. The market is what it is. But what I mean to say is that something is there's discord, right? There's divergence. There's non-confirmation. And one could say, but that's always the case. And, you know, who cares? The market, as measured by the S&P, is making new highs. But we're seeing it in the stocks 600 in Europe, for instance, right? It's struggling. The DAX, the biggest player in the EU, is starting to roll a little bit. So it's just uniquely and specifically, and that's the nature of the word idiosyncratic, a few names, but most notably the move in Apple and NVIDIA just over the past 48 hours is enough to cause the gap in the S&P. And we're probably going to fill that today, if not tomorrow.
And I'll say this real quick, Dan, because we're going to talk about yields, but there was just a 30-year Treasury auction, which apparently went better than expected, which is why I think you're probably seeing this little bump up in the TLT and that additional leg lower in yields, which you sort of teased earlier, and something that Carter's been talking about, obviously, for quite some time.
Yeah, no doubt. Hey, Carter, help us through these next two charts here, because a lot of folks, they can understand the pictures that you just presented, right? The minor breakout, which is what you called in the market cap weighted SPX. And then we had the RSP, which is the equal weight SPX. Looks like it's breaking down. It's consolidating above that uptrend, right? That's been in place since October. Help us understand this chart right here.
Yeah, so it's not about the axis, the Y axis. It's the direction of the brown line. If the brown line is going up, it means that the equal weight S&P is outperforming the actual. And if the brown line is going down, it's the opposite. It means the S&P, what's 1 divided by 500? That's 2% each. Is that right? Have I got that right? Or no, 20 basis points each. Yes. So that if every stock is the same weight, and one could say, but that's so stupid. Why would Foot Locker with $2 billion have the same weight as $1 trillion thing? But what it speaks to is the general health of an aggregate. Right. So that, and the analogy, and they say this, look, analogy is a weak form of argument. They'll say that day one in law school. But the analogy is this: you walk into the arena and you're like, my God, we're killing it. Our team's killing it. And then your buddy who's been there hands you the beer and says, actually, we're having the worst night statistically ever. And you're like, what are you talking about? He said, this guy's hurt. He hasn't scored. One guy, LeBron James, carrying the whole team. Michael Jordan's doing all the work. And so that while the scoreboard reflects the score, and you can say, who cares? We're winning. Michael Jordan, God bless him. The performance of equities as measured by all the constituents, the parts compose the whole comprise the parts, is not good. And one could say it's academic, who cares? But what we know is that at the COVID low, you would expect this because people go to what? Safe big names. So the average stock is underperforming Apple, right? Or Berkshire Hathaway, which are considered safe. But if you look at this and go long-term, look at this. We have a long-term chart. These extreme reading, ironically, have been market bottoms or tops. So the extreme reading in the .com on this relative strength chart, that was, of course, what? A market top, right? So that the average stock was underperforming badly, right? Because you had Cisco and other huge players, Amazon, doing all the work. Then in the 09 low, it was the exact opposite. It was a market bottom, the COVID low, and here we are. We did a poll, institutional clients, Twitter followers, Worth Charting subscribers, and the choices were, is this indicative right now of a market bottom, market top, or irrelevant? Doesn't matter. Who cares? Dumb survey, literally. And guess what we got? A third of the people say, who cares? Dumb survey. And then it's about, if you took the rest of the percentage, it's about 64 that people are arguing this is a top because of this circumstance.
So let me ask you this, Carter, because, unless I'm totally misunderstanding, given that we're at an all-time high in the S&P, it's hard to posit that this is basically a market bottom. I mean, is that accurate?
That's right, Guy. That's, if we got to the simplest, you're like, this is a market bottom? How the hell would one come to that conclusion? But good, yes, exactly.
All right, so Carter, and just to be clear, when you think about this work, we're talking about breadth in the market, right?
Yeah, essentially that's it, right? You're talking about
more breadth is not constructive to build on, right? Because at some point, and we could just throw up an Apple chart really quickly, when you have, this stock gained $300 billion in market cap, right? Just think about that in 2 trading days. I mean, how sustainable is that? We were spending a lot of time in the lead up to Worldwide Developers Conference, talking about what is the thing that would cause this stock to break out to a new range above the prior highs, a level that it failed at, a couple times in the last year or so. Maybe we have a 5-year chart here too. And you could say, listen, take the name off of it and take the underperformance that we've seen, and take, the fact that sales haven't been growing over the last few years and a bunch of other metrics, and margins have been flat. And you could easily have said to yourself, I'm not really sure what could do that, but that's not that, that's a pretty constructive chart, and you have that breakout. So again, I think it just speaks to when you throw NVIDIA in there, in the 2 moves that we've had. It's kind of interesting. I just want to make one point, Guy, and you and I have talked about this. I just pulled up a list in I guess January 1st, 2000, of the largest market cap companies. And obviously it was Microsoft at 600 billion, GE was 500 billion, Cisco was 350, and Walmart was 300. And back then you could have made the same arguments, right? The market, total market cap was much smaller for the S&P 500 and the NASDAQ, but that they had similar sort of weights as we have right now in the top 5 or 6 or so. But the fact, Guy, that we just had Apple gain $300 billion in one fell swoop, and we know that NVIDIA has gained $1 trillion in just a few months or so. What is that saying to you? Again, and here we are. We could have said the same thing 2 weeks ago, a month ago, 2 months ago. What is it saying to you right now, right here?
Well, there's a level of absurdity if you start just thinking about the math of this entire thing. I read recently, I think in the last 8 months or something, $10 trillion has been added to the market cap of the S&P. So let's just think about this for a second. I mean, the U.S. economy, I think, is a $27 trillion economy. I think global GDP is little north of $100 trillion. So when if you just think about the level of which these things have gotten to vis-a-vis the global economy, it just, at a certain point, it no longer makes sense. And I'm not interested in total addressable market and all those things, because I'm not even sure that it matters. I mean, you're just looking at a percentage of U.S. GDP or global GDP, and you're saying, wait a second, something's a bit askew here. And again, I understand a lot of it has to do with money flows and stuff, and there's obviously an exuberance around a lot of what's going on, but mathematically, at a certain point, it just doesn't add up.
Yeah. Hey, and Carter, you just mentioned this. So, yields down, stocks up, right? That should be the formula here. You've had this call, though, for months that you think yields are stuck, and you think they probably move lower, and stocks could move lower under that scenario, probably for some technical reasons on your front, but Guy and I could allude to a bunch of fundamental ones. What's your thought here right now? I see that uptrend. It's a multi-year uptrend. It's held at like a boss, but we're kind of at a couple other levels that you think are kind of important also.
Well, the key is that we're on this trend line, obviously, and one could say, wrong arrow there, buddy, you should be drawing a green arrow. That's the judgment part. But if we look at the next chart, the next iteration, this is the important thing. That was it was a Friday, right? It was October 21st, 2022. That's the market low, right? So that the S&P at that point was down 27% from its peak. The Qs were down 37%, and perhaps for good reason, because rates had gone from 2.5 to essentially 4.5, right? They'd moved up in a matter of 3 months. You can see there in sort of June, July, August, September of 2022. And the extrapolators came in and started extrapolating and said, my God, if we went from 2.5 on the 10-year to 4.5, we're going to be at 8.5. And if we're going to be at 8.5, this market's in trouble. Market crashes. Essentially, we have a bear market, right? And then ever since, it's never really been higher. One could say, well, no, your eyes need to be checked there. It clearly went to 5. That was a blip. 10-year yields have made no progress in almost 2 years. That's October of 2022. We're about to be 4th of July, 2024. There is no higher for longer. I just don't subscribe to that. And I think back to the trend line chart, I think we're going to break this trend line. And look, it all could be, though, with this big asterisk. Who cares? Maybe rates are just in this Goldilocks 4.5 to 3.5, and it never is going to 6 and never going to 2, and just don't worry about it. But
yeah,
my bias is lower.
No, and it's interesting. So you can look at it yields, or if Amanda or Jacob can put up a TLT chart, and that same uptrend that you're drawing, the TLT is the inverse of that. And obviously there's the same downtrend in the TLT. So let's throw that up and just take a quick look over the same period of time. Because again, you can draw that downtrend line and it's going to look eerily close to what you're talking about. I mean, we're probably, within a point or two in the TLT of breaking out of this long-term downtrend. So that's the rub. I mean, the moving average, you see the moving average there, Carter. You see that we're right around it. We've been trading either side of it for quite some time. It hasn't turned up yet. I don't know if that necessarily matters, but your point about the uptrend in yield, it's the same point about this downtrend in the TLT.
All right. Price is the inverse of yield. Then you cannot buy yield, right? You buy price. So the question is, at the end of the day, is one buying long dated treasuries? Yes or no? I am.
Yeah. All right, Carter, we appreciate that. Before we let you get out of here, we want to hit a couple software names. Adobe is reporting tonight after the close. The implied move in the options market is about 8% in either direction. Over the last few quarters, the stock has traded off the day after 13.5% when it reported in March. It was down 6.5% when it reported in mid-December. It was down 4.25% when it reported in September. We've highlighted over the last few months just the relative underperformance that this stock has had rather to the market, its peers, and the like. The fundamental stuff we don't have to kind of get into. When you look at this 1-year chart, we see that gap, that 13.5% gap from 13 months ago. You see the moving average, which is kind of flatline but kind of moving down. Let's look at a multi-year chart. I think we have it here. This is one, and we'll get Guy's fundamental take after this. We just kind of want to quickly get your technical take. In the last 2 weeks, we've had, some stocks that some would call peers, right? Well, if you want to look at Oracle, just the other day gapped up, 13% yesterday, Guy, after a beat that you and I were not that impressed with. And then the flip side of that is last week, we saw Salesforce have its largest down day in one day, obviously, 21% or so. Over after an earnings miss that we didn't think was that bad either. You know what I mean? So Carter, talk to us a little bit. Let's go back to the Adobe 8% implied move. Any thoughts there? And we're not asking you to kind of force anything.
Yeah, no, I mean, the group is under pressure, right? Salesforce, you had Intuit collapsing on its number. I guess that was around the same time, maybe 2 to 3 weeks ago, as the CRM. So this sort of, whether you call it application software, I don't know what, but its software is been under pressure, Autodesk and so forth. I wouldn't want to be long going into the number. I would just say it that way. I would, if I were, I would reduce the long exposure. I might hedge it out. But this is a darling. Wall Street's got a price target of around $610. I don't know where it's trading here, $450. I mean, that's a tough lift from here.
Yeah, you look at it. I mean, it's again, like many of these stocks made their all-time high right around the time when the Fed decided they were going to start raising rates, made sense. And the stock, which again had been impervious to valuation concerns when interest rates started moving higher, they obviously fell victim to that. The whole thing makes sense. And then the stock was resurrected as the market found its legs, and people started saying, actually, this looks attractive. The problem here is, in my opinion, a couple things. It's still not particularly cheap, but it never really has been. It typically doesn't trade great after earnings, as you just addressed. And then you have the third kicker, where the investment dollars on the side of the investing community are clearly going to AI, and the investing dollars in terms of CapEx are seemingly going to AI. Now, I don't know if Adobe is going to be spared from that, but I don't think it's a particularly great setup here. But we'll see. We'll talk about it next week if they beat.
Yeah, this is a really tough one here because, again, we're juxtaposing Oracle versus Salesforce. This is a company that was telling a story about generative AI last summer. Didn't exactly play out the way a lot of folks kind of thought it would. And Guy, I thought you'd mention a little bit, 12% expected EPS growth over the next 2 years, this year and next, and then 11% expected sales growth, right? And so you think about this, 89% gross margins. You know what I mean? Like if they can just guide up a little bit and have a small beat, I suspect the stock is moving higher. That being said, in line in the guide lower, and the stock is let's pull up the Adobe chart here. It's trading like 461 here. The stock is easily going down that 8%. Let's pull up the 5-year chart. It's going to be right through those lows from last week, and then you probably get back to that breakout level, from late last year. So again, tough press here on the short side, but by the same token, expectations are really low, and you can see this thing on just not that big of a beat and guide higher, moving higher. So Carter Braxton Worth, we really appreciate the heavy lifting you've done here today. We're going to see you on the market call on Tuesday. Have a great long weekend.
You too. Bye, guys.
Hey, Guy, we probably have some time for a few questions here. So if people want to throw those in, Amanda will put them together and put them in front of us. But it's time. And I know that you get excited on Thursdays. Our main man, John Butters, he's the author of the Earnings Insight blog that's over there at FactSet. You can have it in your inbox every Friday morning. Here it is, insight.factset.com/subscribe. Guy and we get a little bit of a preview on Thursday, and we get to talk about it. So let's do this. We often talk about ratings on Market Call. This is analyst ratings, right, for individual names. We talk about it on Fast Money. Sometimes people ask us, why do you guys spend so much time on this? Well, really, it's just one input. It's one gauge as we think about sentiment. And oftentimes you'll hear us say, well, investors are obviously really into this story. And we talked about it earlier in the week in Apple. Of the Mag 7 guy, Apple has the lowest percentage of buy ratings versus Amazon, versus Microsoft, versus Meta, versus Google, and some of the others. And I think that's interesting. So sometimes Wall Street analysts are off sides relative to, let's say, what investors think. Before we get to Butters' work, talk to me how you think about that, because you were on the sell side. You used to deal with a lot of institutional clients. This was years ago, and they always wanted to know what an analyst was thinking and why, and why they only have a hold on a stock that's performing really well and stuff like that.
I think, again, I don't think you can necessarily, I don't think you're suggesting this, you can't trade on the back of this, but it's a great indicator as to sort of how the street's lining up, and especially when you look at individual names, if everybody's on the same side of the boat, or conversely, if people have missed the move entirely and they're playing catch up. Sometimes when they all finally figure out the story, they do it basically in the 11th inning and they're too late. So I just like to know it just in terms of sentiment and stuff. And you mentioned Apple, but I think Nvidia is going to be an interesting one when you seeing analysts trip over themselves, and correctly, by the way, to raise their price targets. But it's just a matter of time before one of these analysts goes one iteration too much, and that's going to sort of, I don't know, mark a bit of a short-term top. And that's why I always find these things so interesting, and why I find this one, and we can talk about Butters' work real quick. Basically 55% of stocks buy ratings. I mean, that's the historical norm, or at least so much over the last 5 years or so, which I do find interesting given the strength of the market. I would have thought it'd been higher than that.
Yeah, right. So they're saying it's basically in line, nearly equal to the 5-year average of 54.5%. I think that one of the reasons why, let's say, we're stuck just above 50-50 is that, I think 90-some% of the analysts who cover, and there's probably hundreds of analysts who cover, let's call it the Mag 7, they probably have buys on the stocks, right? Or strong buys and the likes here. So let's break it down by sector. The communication services, energy, and technology sectors have the highest percentage of buy ratings, which is what, you and I just qualitatively could have made that sort of guess, right? The consumer staples and materials sectors have the lowest percentage of buy ratings. And let's hit that for a second here. Does that have something to do with rates, Guy? Because again, we know that a strong dollar, higher rates is a bit of a headwind for a consumer staple, which oftentimes people think with, paying high dividends and the like.
Rate sensitivity more so over the last couple of years. Well, it's interesting. Yes, rate sensitivity should be a factor without question. Then the flip side of the equation is, the broader market seemingly done well, regardless of what rates have done, which is sort of Carter's point earlier. So, no, I do think to a large extent, this breakdown has a lot to do with yields without question. And then basically the economic sensitivity of each of these groups to yields, which, by the way, is going to lead to a question we have from one of the audience members.
Yeah, no doubt. All right. And the last point from Butters' work here, the percentage of buy ratings on the S&P 500 stocks has increased over the past 4 months, led by consumer discretionary and technology sectors. And I guess, we're in the 6th month of the year, Guy. We can do that math, right? And the S&P is up nearly 14% of the year. The NASDAQ composite is up 17.5%. So a lot of analysts, they don't want to get caught off sides, right? And so, over the last 4 months, as the market has made basically seemingly new highs every day, they're kind of, saying, hey, listen, or the research director is saying, hey, listen, when are you going to start getting on the boat or getting on the train or whatever kind of vehicle you think is moving forward here? And that's why you've probably seen that acceleration in buy ratings, guys.
You don't want now's the time of year where, if you've been behind the 8 ball, you got to start playing catch up. And that's what I think you're going to start to see. And again, I don't know if that's suggestive of a top or just a continued momentum, but it's definitely something that you want to be on the lookout for. And quite frankly, given the fact that 54.7 is in line with the last 5 years, I mean, you can make an argument that that's actually sort of a bullish thing because the market, at least on the analyst side of the equation, hasn't gotten all that exuberant yet, or at least excessively exuberant, I should say.
Yeah, no doubt. All right. Well, thanks to John Butters. He is the senior earnings insight analyst over there at FactSet. And again, if you want his work delivered straight to your email inbox, you can go to insight.factset.com/subscribe. All right, Guy, before we get to some questions, one of the first things that I'm doing often days when I leave here the office at 4 o'clock and I'm going to get on the subway, it's about, 7-8 minute walk to the subway, or it's about a 7-minute subway ride up to the NASDAQ. And we get up there and we do a call and we get a little makeup on, and then we head up to the set and we start doing that show at 5 o'clock. But I have this period of time, whether it's my walk or on the subway, about 7-8 minutes. You know what I've been doing over the last couple of weeks, Guy? Do you have any idea what I've been doing to keep myself busy on that walk or on the subway ride?
Listening to Brunson on the Market Matrix.
Well, there you go. And again, so if you want to get up to speed in about 7 minutes, okay, on a bunch of stories that Guy and I and our team think are the most important market moving stories or economically related or anything, you can go to your podcast store. You can look for MRKT Matrix. That's a podcast that we use. It's AI generated. It's not generative AI, guys. So it's not generating the story as we're going here. We find the stories, the ones that we think are impactful. If you're not staring at FactSet machines all day long like we are, this is going to get you up to speed. So go to your favorite podcast store, subscribe, download, listen, rate it, review it. It's how people find it, guys. So that's the Market Matrix.
Discovery. And it is pretty cool. So thank you for the people that have subscribed. And again, you want to leave a review, feel free. We have a question from Griffin Keenan. Throw it up, Amanda. How sensitive, and this goes back to what I teased earlier, how sensitive is the IWM to moves in the dollar? Thank you. And, that's what we were saying. If you think about it, the moves in the dollar a lot of times are predicated, Griffin, in terms of the moves in the bond market. So theoretically, one would think if yields moving lower, which they've been, it would create a bit of a cushion or a little bit of a support for the Russell in the form of the IWM. But once again, if you throw up a chart, I mean, for whatever reason, that 207, 208 level, which we have flagged a number of times, and if you go longer term, you'll see, has stopped on a dime. And yet a pretty big downdraft yesterday and sort of today. So I'm not really sure what now the Russell or the small caps are predicated on, because at least over the last couple of days, it's certainly not it's not being bolstered by lower rates, Dan.
Well, I just think that the reversal off of yesterday's high, so we gapped higher, okay? It actually made its high, like an hour after the opening, Guy, and then it spent the next, 5 hours, 6 hours, and it closed on the low. And then to fill in that entire gap now today, that is just really, really poor action, in my opinion. And, when you think about what's gone on here, you have a dollar that's actually, now it's up today, and it's so it all makes sense to you and me. But the rate thing doesn't make sense relative to what's going on with the dollar. So again, you and I are confused. I know you have a dog named Russell, and one of my favorite movies, one of the main characters' name is Russell Hammond. Every time we talk about the Russell, I always think about your dog, or I think about Russell Hammond. So we got that. What else do we got?
I don't know who's Russell Hammond.
Russell Hammond was the lead guitarist with Mystique in the band Stillwater, which was featured in the movie Almost Famous, which you should like that movie. You are one of the biggest Allman Brother fans that I know. That movie was written and directed by Cameron Crowe. And when Cameron Crowe was a wee teen in the 70s, he actually was a rock writer. This was semi-autobiographical, this movie, and he was touring with the Allman Brothers, writing, I think, for, Rolling Stone or something. So that movie, one of my all-time faves. I think it's about 25 years old right now. Guy, do you like that movie? Have you seen that?
It's fine. I mean, it's probably not my top 50, but it's It's fine. It's all good. I mean, soundtrack's very good, as they say.
Great soundtrack.
By the way, this yields to go to Michael Coletta's question. With yields lower, small caps not moving. Any thoughts? So we just provided those thoughts, and I'm with you, Mike. I don't really get it. Matt Walters asking, Dan, thoughts on regional banks? I mean, we look at the KRE, and what I'll tell you, Matt, that again, they haven't been trading particularly well. I mean, they've been sort of going sideways here, but you can look at the KRE and you'll see, there's something seemingly amiss. And if you go back longer term, you'll see, we're nowhere near its prior high. And yeah, we bounced off the Silicon Valley low, but it's been going sideways now since the fall, Dan.
Yeah, and we've highlighted this, I think, on numerous occasions over the last few weeks, few months, whatever you want to, say. I mean, like, listen, if this thing were to kind of break out and make some new highs above those kind of December levels, I'd say, okay, the party's on. It would show some sort of broadening out. We've seen this massive rush towards, these large money center banks over the course of this year. JP Morgan, was just at an all-time high after a huge gap back on April 12th after their Q1 results and some of the things that Jamie Dimon has to say. And I'll just say this, Guy, when, the knee-jerk reaction, if you talk about KRE and their exposure to commercial real estate, yesterday, you and I were talking about it with rates lower right after that CPI, like stocks like BX, that would be the Blackstone that has a lot of commercial real estate exposure through their BREIT, that stock was raging, closed on its low. Let's do a 3-day chart. Doesn't look too different, right, than what we saw out of the Russell 2000. Look at that gap and look at where it is right now. So closed on the low yesterday and not making a whole heck of a lot of progress, down a little bit today. So again, you've mentioned this on many occasions. There seems to be trouble lurking in the commercial real estate space. And then the question is, what is the knock-on effect? Private credit, we spent a lot of time talking about that. That's an area a lot of these private equity guys are playing in. But really, what's the exposure away from regional banks to some of these large money centers?
And listen, and I think that's going to be the rub at some point, right? And I think one of the reasons that Jamie Dimon made the comments that he made a couple of weeks ago, to a certain extent, is probably predicated on a lot of this. The concerns of a year or so ago have been pushed to the rearview mirror, but I don't think they've gone away. I mean, all those things. I mean, Silicon Valley Bank was its own animal in terms of the ability for people to withdraw their funds in a extraordinarily quick way, because there was basically a same deposit base of people and they all talked to each other, and that's what you saw. So I don't think you're going to see something like that again. But with that said, the unrealized losses on the balance sheets of these banks are staggering, and that's got to all come home to roost at some point. The last one, Dan, from Gary Webb, thought on specialty finance credit card companies seeming to be breaking down. And it's funny, you mentioned American Express the other day, and maybe, and because MasterCard and Visa a little bit as well, although there's just transaction companies, maybe we're starting to see some credit concerns creep their way into the market.
Yeah, I mean, listen, American Express is not one that we would have thought at this stage of the game. Yesterday we were talking about some of the stuff on fast money, and my comment, and I know you agree with this, I probably beat you to it, is that there's really two economies right now when you think of the U.S. consumer, right? You have a consumer on the high end that's, well employed and maybe have benefited from some of the wage situations. When you think about inflation, they've also benefited from that, right? Because things that they own, risk assets, whether they be stocks, whether they be their home that's locked in at a very low mortgage rate or whatever, they've been inflating higher, right? So you have this wealth effect that's been created on the high end. On the lower end, you have, a consumer that, and you made this point on many occasions, they're trying to figure out between auto and auto insurance that they need to get to their jobs or maybe multiple jobs, and the increased price in, food at the supermarket, a whole host of other things, and they're having a difficult time. So bringing back to American Express, I would think that the consumer or the customer that they have is not really that stressed at the moment. So the question then is, like, why has the stock gone from 244 on May 20th to 222 and breaking down of that like really well-defined uptrend? And, there wasn't a gap on that earnings day if you look at it from a month and a half ago, but it's basically, if there was a gap, if it had moved higher, just what got stronger over the course of the day. Well, now here we are, it's filled in that gap. And you might say, all right, maybe it's getting towards good technical support, but I'd put more emphasis on the break of the uptrend than that consolidation before it kind of made that move higher and then went to new highs, guys.
Okay, I think you got to watch this one closely, because this is going to be just the same same way Discover Financial and Capital One.
Yep.
Those were the sort of the precursors to some credit concerns. American Express is going to be similar, I think. So it's nothing to worry about yet necessarily, but it's clear, to your point, something's been happening over the last couple of weeks. So
yeah,
that's it.
Yeah. One last thing, guy. I just want to get your take on this. So if they could pull up a 1-year chart of Tesla. So a couple days ago, we were talking about how it was kind of breaking down. It had that, that one down day. Let's see if they can move it over. Yeah, you see that, right? It didn't really break down, but it was down a few percent or something like that. Felt like it had the potential to go lower. Today, the stock gapped up, I think, more than 5 or 6% or so. Elon Musk, I guess, tweeted out something that the pay package, this $46 billion pay package that he was awarded in 2018, which got struck down by a Delaware court. They're voting today on that package. Okay. They're also voting to move the company to Texas because they want to get around that Delaware decision. Okay. At least the corporate structure. Look at that move. And let's look at a 2-day or a 3-day chart really quickly. So the stock gapped up. The whole idea, guy, is that if he gets the pay and he gets 25% ownership of Tesla, then he's not going to move a lot of the work that they're doing in around XAI or generative AI and the like. So you got full attention, or not full attention, because he is the CEO of SpaceX, the CEO of Twitter, the CEO of Boring Company, the CEO of XAI, and also the CEO of Tesla. But the idea is that he has no incentive to leave or anything like that. What do you think would happen after this gap here? Let's say the package doesn't get approved, right? You know what I mean? And who knows? You know what I mean? Like, does the stock gap lower, and does it find itself breaking out of this range?
I think it was last week. Although and I think we mentioned this yesterday. We had Mel posited a question about 2 analyst calls on the same day. Yeah. I think one had a $200 price target and the other one had a 125. And she said, "What do you think?" I said, "Well, I'm not trying to be cute here, but I think they're both going to wind up being right." And my point was, you've seen spikes in this stock before on just basically incremental news that'll take it up those types of percentages. And then, but the upper left, lower right, I mean, the decline in the stock is still in place, and it's actually sort of playing out the way we thought. So I guess the long-winded way of saying, to answer your question, is, yeah, you absolutely could. I think it probably did its work to the upside. I think it got up to 191 today, but you understand my point. I mean, You have seen bounces along the way.
No doubt. All right, Guy, we covered a lot of ground. We got a lot of great stuff from Carter Braxton Worth. You and I are checking out of the market call for the rest of the week, and, we have a really good on the tape episode that's coming out tomorrow morning. Danny Moses with his friends, Vincent Daniel and Porter Collins. Guy, I heard it was straight fire. So the 3 of them, that's dropping tomorrow morning in your favorite podcast store. Find it, rate it, review it, listen to it, subscribe to it, do all those things, Guy, right?
Well, I've already done that preemptively.
Yeah, well, you did it a few years ago when we started the company, which was really helpful for you to be, subscribed.
By the way, I believe the Yankees are starting a game today around this time.
Okay.
Or maybe in an hour. I don't know.
Kind of odd for them on a Thursday.
Getaway day. 4 games set in Kansas City. Day game. They got to fly to Boston.
Oh, gotcha.
The Royals are doing the right thing. So there you go.
Are you excited for a Sox-Yanks series here or what?
No, not particularly.
How about the fans, baby? You think they're going to sweep? You think they're going to win tomorrow night?
Well, if the Mavs were going to win a game, it was last night, and but Boston's just a better team.
Yeah, they're really good. All right, Guy Adami, this was a lot of fun. We'll see y'all. Guy's going to be back on Monday with Danny Moses, a very special market call on a Monday. So we'll see y'all. Have a great weekend. Thanks.